All right, let's talk about a strategy that a ton of investors just sleep on. You know when the market gives you lemons, right? Those investments that are down? Well, there's a way to turn that into some serious tax lemonade. It's called tax loss harvesting, and honestly, it can be a total game changer for your portfolio.
Now, I want you to think about this for a second. That 10 grand you're down on a stock, it's not really a loss. Not yet, anyway. Right now, it's actually a hidden opportunity. See, on paper, it's just an unrealized loss. But the second you hit sell, it becomes very real for the tax man. And that's exactly where we find this little thing called tax alpha. Okay, burn this number into your brain. $3,000. Why? Because that's how much the government lets you write off against your regular income, like your salary, every single year just by using your investment losses. It's an incredible silver lining that can literally put cash back into your bank account.
So yeah, that 3 grand is a big deal. It directly lowers your taxable income. But you might be thinking, what if I lost more than 3 grand? Well, good news. The IRS doesn't just make you eat that extra loss. It's called a loss carry forward. You can actually carry those losses into future years to either wipe out capital gains or keep taking that $3,000 deduction year after year. It's like a tax-saving gift that just keeps on giving. All right, so what is tax loss harvesting, really? Let's get into the nitty-gritty of how you actually capture this tax alpha and make it work for you. It sounds complicated, but I promise it's not. The devil, as always, is in the details. Okay, super basic, but this part is crucial. A capital gain, you sell for more than you paid. A capital loss, you sell for less. But the magic word here is sell. Until you hit that button, it's all just monopoly money on your screen. The second you sell, you've realized that loss. And boom, the IRS suddenly cares. And that is the whole game right there. You are strategically, intentionally selling something at a loss. Not because you hate the stock now, but because you want to create a tax deduction out of thin air. It's a pure tactical play to slash your tax bill. Think of it like this. It's a simple two-step dance. Step 1, sell something that's in the red. Step 2, use that loss like a get-out-of-jail-free card for your winners. For every single dollar you lose, you can wipe out $1 of gains. That means those winning trades can become completely tax-free. How cool is that? Okay, it sounds a little too good to be true, right? Well, here comes the catch. There's a big, nasty trap that so many people fall into, and most of them don't even see it coming. The IRS wasn't born yesterday, and they have a rule just to stop you from gaming the system too easily. So the first thing everyone thinks is, okay, I get it. I'll sell my losing stock to get the tax break, and then I'll just buy it right back 2 seconds later because I still think it's a good long-term investment, right? Makes perfect sense. But nope. And here it is, folks, the infamous wash sale rule. All it means is the IRS says, hey, you can't claim a loss on something you basically never got rid of. If you sell it and then buy it back too quickly, they just pretend the sale never happened for tax purposes. Your loss is disallowed. You get nothing. Zip. Nada. And check this out, because this is where people really get tripped up. It's a 61-day window you have to worry about. It's not just 30 days after you sell, it's also 30 days before you sell. So any purchase, even a small one, inside that big 2-month window can completely blow up your plan. But wait, it gets even trickier. It's not just about buying back the exact same stock. The IRS uses the sneaky, fuzzy phrase, substantially identical. And what does that mean? Well, that's the million-dollar question. And it's where well-intentioned investors accidentally get themselves in hot water. So what do you think is the #1 way people trigger this rule without even knowing they're doing it? I'll bet it's happening in your own account right now, probably on autopilot, and you have no idea. Yep. It's those automatic dividend reinvestments. We all have them, right? The drips. Just picture this. You smartly sell a stock to book a loss. But oh wait, 2 weeks later, the company pays a dividend. Your brokerage, just trying to be helpful, takes that little bit of cash and automatically buys you a couple more shares. And just like that, poof, that tiny automated purchase just nuked your entire tax deduction. It's gone. Yeah, a drip is supposed to be great for compounding your returns, automatically buying more shares for you. But here's the brutal truth. The IRS doesn't care if it was you or a robot who bought the shares. A purchase is a purchase. And if it happens in that 61-day window, that big, beautiful loss you planned so carefully to harvest, it's just disallowed. Okay, so what do? We want the tax loss, we need to avoid the wash sale,
But we absolutely do not want to be sitting in cash while the market potentially rips higher. How do you solve this puzzle? Well, there is a really, really smart and elegant solution. And this is it, the ETF swap. This is the pro move. The idea is simple. You sell your losing fund, and in the very next breath, you buy a different fund that's really, really similar, but crucially, not substantially identical. You stay in the market, you get your loss, and you sidestep the wash sale rule completely. So let's look at a classic swap. You sell your S&P 500 ETF, let's say SPY, it's down. Then you immediately buy a total stock market ETF, like VTI. Now, if you look at their charts, they move almost in lockstep, right? But here's the magic. SPY tracks 500 big companies. VTI tracks like the entire US stock market, thousands of companies. Because they track different underlying indexes, the IRS says they are not substantially identical. And that right there is the key. So here's your playbook step by step. 1. Sell the loser your S&P 500 ETF. Lock in that loss. 2. Immediately, and I mean immediately, use that cash to buy the replacement, the total stock market ETF. And 3, just wait at least 31 days before you even think about swapping back, if you even want to. And that's it. You did it. Tax alpha captured, market exposure maintained, wash sale avoided. Check, check, and check. Okay, we're almost there, but there is one final critical warning I have to give you, because when you do this is almost as important as how you do it, and most people get this wrong. It's what I call the procrastination tax. You know what happens. Everyone waits until the last week of December to do their tax loss harvesting. They think they're being so savvy, but they are all walking single file right into another expensive trap. Just look at the numbers. Trading volume absolutely plummets at the end of the year. All the Wall Street traders are on vacation, the big funds have shut down for the year, the market becomes a ghost town. It gets really, really quiet. And why does that matter to you? Here's why. That low volume creates what we call a wide bid-ask spread. That's the gap between the highest price a buyer will pay and the lowest price a seller will take. And in a thin market, that gap can get huge. It's a hidden transaction cost that can gobble up like 20% of the tax savings you were trying to get in the first place. You're losing money just by waiting. So, what's the bottom line? The absolute worst time to think about this stuff is December 29th. The best time is, well, it's all the time. It's a year-round opportunity. So now that you know the rules, you know about the wash sale, you know about the drip trap, and you know about the ETF swap, the only question left is, when are you going to go find that hidden tax alpha in your own portfolio?